I would like to ask the panel now to join me. We will hear the other side of the divestment coin. If you just come and gather around me, that would be wonderful. The other side, Reinhard Bütikofer this morning said, is the investment side. And so what do you invest if you divest? These are hopefully answers you have to offer us. And I will introduce everybody the moment he or she starts with his or her presentation. So we start with the person who was already mentioned this morning by Bill McKibben in his speech, Mark Campanale. He's founder and executive director of the Carbon Tracker Initiative. And he was the one describing the carbon bubble we are sitting on. That is the picture Bill McKibben used. And so you have the word.
Okay, thanks very much for that introduction. I don't know, some of you may have seen it. A couple of months ago, there's a Brazilian company called Petrobras. It's one of the largest oil companies in the world. They issued a 100-year bond. It was 8 times oversubscribed by institutional investors. Now think about that a minute. What's written into that? Well, what's written into that is the assumption that the demand for oil in 100 years will be as great as it is today. Why else issue a 100-year bond? And in it, it illustrates the disconnect between the climate science that is all familiar to us now and the way financial institutions and financial markets act, and they ignore the obvious. Carbon Tracker's first report just put a couple of statistics out there. One of the ones which I want to come back to is time. Time is the crucial one in this formula, because one thing that we don't have is time. Time is against us on this. This is the illustration of the carbon budget and the carbon bubble. If we allocate a carbon budget to the listed fossil fuel sector, which is just a fraction of all the fossil fuel reserves, it's the green, and we look at the reserves, which is the blue, what I want you to focus on is the red. What the red is what companies are telling markets they plan to do next. And as you can see, the red doesn't fit into the green. What the markets are actually thinking, and Carbon Tracker, we have a lot of interaction with investors and with companies, and here are some of the things that the companies are saying. They're saying, to get to 2 degrees, there has to be a massive collapse in demand. We don't see a low demand scenario. And in fact, what we know coming up in Paris with the COP is the INDCs are setting reduction targets of 30 to 40%. What are the companies telling their shareholders? They are saying that during the same period there will be a 30% growth in demand for fossil fuels. That's the narrative that there's. And we say, well, what about telling us about this low demand scenario? What will happen if the company cannot develop the reserves? And they have one response, which is there is no low demand scenario, because of course all energy demand into the future is going to be met, also they say, from fossil fuels. And there we have the conundrum. What do investors believe? What do institutional investors believe? The IEA tells us that between now and 2030, here's the figure, you can look it up, $21 trillion will be spent on finding more fossil fuels. And where's the capital for that going to come from? To hit this 2 degrees target, on the left-hand side, you've got the trend scenario and the downturn. You have to get to the lower, lighter shade of green to get to 400 parts per million, or the other green one just above it, 450, which is roughly adjusted to 2 degrees. The picture on the right shows you where we're going to with business as usual, and when we'll hit 2 degrees, which is somewhere past 2 degrees and then on to 3 degrees, which is not there long after, maybe 20, 30 years' time. Why is that crucial? It's the projects that are investors are backing today and companies are committing to today, which will come about and really drive us through those targets. So it's what the campaign, the divestment movement is doing today, which is really crucial. So what's Carbon Tracker's analysis on this? I just want to take you to one slide. We're just a team of ex-Wall Street, ex-City of London, investment bankers and analysts. So we have people from Citigroup, Barclays Capital, Deutsche Bank. The ex-head of oil and gas for HSBC now works at Carbon Tracker, and we produce these very technical reports where we're looking and we're trying to map where all this capital is going and where all these projects are coming on stream. So how do we get to 2 degrees? Well, when we think about divestment, I think of it in 2 or 3 ways. One is we sell the stock. So institutional investors can sell the stock, and there's very plausible, very strong, compelling financial reasons to do that. The other way we get there is to get companies to cancel projects. And the good news is that as of today, over $200 billion worth of oil and gas projects have been cancelled in the last year because of what's happening with prices. And if this trend was to continue, it's a good sign, it's a good picture. And on the screen, what you've got here is some of our analysis. What we're doing, using our analytical team and using the databases which we access, like the Wood Mackenzie database and the Rystad Energy database, is we're modeling every single major coal, oil, and gas project around the world and their carbon intensity, and trying to look at, what we on the left-hand side there, the break-even price. How much does it cost for companies to develop an oil project? And in it, if it costs you $100 to develop an oil project, and oil's around $50 a barrel, you wouldn't do it. We cluster those up at the top right-hand side, the losers, and on the left, well, survivors, people that are still going to be around in a few years' time as the fossil fuel age comes to an end. So it's quite technical, and where we work with institutional investors, when we speak to them, and I did a big call with some pension funds last week, is they want to know which companies do they own and which projects have to be cancelled and how do they engage, which is what the engagement community is trying to do, is get them to stop doing these projects. Here's the bad news for the industry. What this shows you is 2 things. One is how much capital Chevron and Shell and Exxon are having to put in to find new oil and gas projects, which is the orange line, and the blue line shows you the production. And all that is simply telling you is that to find the next barrel of oil, they're having to spend more and more and more capital in finding that next barrel of oil. And in fact, it's becoming uneconomic. And Goldman's produced this rather wonderful chart. This is when oil was at $70 a barrel. And this is just another version of our carbon cost curve. Along it is the break-even price and cumulative production of oil. And what you can see on that, lots of different projects from Russia, the Middle East, and around the world, Canada, heavy tar sands, is only the ones where the red line is where oil was at $70. And remember, it was down at $40 just a few weeks ago. All those projects are uneconomic. And today, I don't think it's an understatement to say that the oil industry and the mining industry are in crisis because it's costing more capital, too much money to get these projects to be viable, and oil prices are very low. So it's a technical approach, but what it does is it argues that there is a very strong financial case. Why own a company where if it costs you $100 to get the oil out and all you can do is sell it for $50, why would you invest in that company? There's no reason why you would do that. So in our view, we're seeing the beginning of a very rapid transition. Investors are moving out of fossil fuels, and this graph shows you the new projects on the left, and moving into clean energy. The central part of the divest invest is divest invest. It's about finding the opportunities for the clean energy transition as much as it is about getting out of the old. So Paris is going to be an important milestone, a stepping stone, really, into bringing the financial community to the table behind a climate deal. And how do we resolve this contradiction? INDCs, 30-40% reductions, the city, the oil companies saying, no, it's going to be 30% growth. These 2 statements cannot be reconciled. And that really is the challenge that we have to face ahead of us, and whether we're going to see more decline and more growth, which is what we predict. Thank you.
Maybe in the discussion we come to the point why oil companies chose to ask for a carbon price and so on, and backing up Paris. So nearer to Paris, Pascal Canfin, he's co-chair of the Commission of Innovative Climate Finance. He has been the development minister and has been in the European Parliament. Like like Mark before, he has a lot of hats. So give us an idea about what to do with that money.
Well, maybe before I would like to start with a personal story. So as you said, a couple of years ago, I was in the Green Group as a member of the European Parliament. And we negotiated the directive, the European directive on the credit rating agencies. And we were the only political group tabling amendments that stated that credit rating agencies, such as Standard & Poor's, Moody's, and others, should and would have to assess the climate risk exposure of the companies. They assess and they rate. And we were the only political group to support that kind of amendments at the beginning, and we were the only one at the end. What is interesting, and it illustrates the huge shift in the cultural battle we are in, is that 4 years later, so just 4 years later, S&P is doing this assessment of climate risk exposures of the biggest listed companies they rate on a voluntary basis, because the CEO of S&P, and S&P has not become a philanthropic institution, unless I'm wrong, is saying, well, I cannot ignore anymore the climate change as a risk for the investment, so I have to assess and I have to rate the companies regarding to the exposure to that risk. So you could argue that 4 years ago it was also true, and obviously it was also true. They are fully late, they are late, but they are moving. So that's interesting, because in 4 years, what the politicians, and left and right all together, were just not able or brave enough to impose, on a voluntary basis, the financial industry is starting to move on because of the figures you mentioned. And it's just the start. And now the role of politicians is to speed up that transformation, because we are in a time race. I mean, we don't have decades to change, we have years to change, and otherwise it would be too late to have a space to get back to the 2 degrees. Maybe I could use one slide on just to illustrate. Yeah, I don't know if you can see. Yeah, so that's you mentioned mainly oil in your presentation. That's a couple of figures on coal from Australia and from China. So from Australia, that's the share value of key coal producers in Australia, and the same is happening in the US. Look at the trend and the figures, and it's even worse now. The figures ends in September, so a year ago, but it's even worse now. -80, -69, -86, -49, and so on and so on and so on. So the idea that there is a trade-off, or there should be a trade-off, or it has to be a trade-off between the interest, the economic rationale, and on the other side, general interest, climate change, moral. I mean, it's something which belongs to the past, and which definitely is not the good frame for the future. So it is happening now. It's not in 10 years' time, it is happening now. And when you look at the figures in China, which obviously is the main driver of the coal market, then you have a dramatic change as well, because the coal consumption has dropped off 8% in a first quarter of this year compared to last year. And the peak for the coal was expected in 2020, and it happened already last year. And the situation is deepening or worsening, if I take the other side, quarter after quarter. So this is happening. So we have many now figures, facts that illustrate concretely that there is also, beyond the moral issue, which is obviously key, but when you are in the city, when you are in La Défense, when you are in Wall Street, the moral case sometimes belongs to another universe. So you have also to have an economic rationale, and it is happening. So we have to, and we should use both, depending on the community we are talking to, or depending on the situation we are in. We could use both the moral case for divesting and the economic rationale for divesting. And I don't know, I have as well. So that's the solar PV prices, and we all have these figures in mind, and it's very dramatic, obviously. And then, maybe to conclude, that's interesting. Going back to, and I took that from a Kepler-Chevreux analysis. He's maybe in the room, so thank you for sharing that. And a copy left. That's the first Dow Jones index, the very first Dow Jones index in New York, sorry, in 1890. You have one sector, just one, railroads. And you take the very same stock exchange in New York 25 years later. None of them is a railroad companies. It has completely been sidelined because the business models have changed, because the economic reality has changed. So it means that in 25 years, so it didn't change for the good when it comes to climate change, but it means that in 25 years, so it's not 50 years, it's medium term, not for high-frequency traders, obviously, but for pension funds, for instance, at exactly the time of the time horizon they have, an index could be, because the economy behind is completely reshuffled and reshaped. And my question to the mainstream investors is, what if we were in 1890?
Ian Simm is founder and chief executive of Impax Asset Management Group, and might not want to answer the question with what if you were an investor in 1890, but he might want to answer the question, what if you're an investor today?
Yes, thank you. I wasn't around in 1890, but I was around in the 1990s investing in solar power, and there's some interesting stories about how investors lost their shirt in solar power. So one person's 80% fall in cost is another person's 80% fall in price, and that can have disastrous effects for investors. Anyway, that was not how I intended to start. We've had some very inspiring stories today about divestment, and yet 99.99% of the money out there just isn't in the room, or if it's not in the room, it's not investing or divesting in this way. So what's going on? I think we've also heard a lot about language today. We're very delighted that our French hosts are willing for us to speak almost entirely in English. But actually there's a very interesting dichotomy between the language of this auditorium and the language that most investors use. And I want to just focus on that for the next few minutes. Why is it that major investors out there just don't seem to get it in the context of climate change? So let's look at the world through their eyes for the moment. One of the key issues if you're an investment manager of a pension fund is risk. And back in 2008, investors around the world realized that business as usual did not necessarily continue, and that there were some uncompensated risks out there which were actually systemic, and regulators have worked hard for 7 years to try and address those systemic issues in the financial sector. So the natural question for investors post-2008 was, are there any other systemic risks out there? Could they be waking up one morning as the proverbial turkey who's been used to gobbling around for 4 or 5 months peacefully, but suddenly faces Thanksgiving or Christmas and has a dislocation to their lifestyle, which is somewhat irreversible? So are there any turkey-type experiences? Well, certainly there's been one major turkey in the last 4 years ago, which was the BP share price in the wake of the disaster in the Gulf of Mexico. Is that systemic risk? Well, probably not. That's more a stock-specific or company-specific question. Systemic risks don't necessarily manifest overnight, and actually we'll all be familiar with the frog in the pan of water. And actually the fossil fuel sector, as we've heard from several people, does have an illustration of that effect over the last 4 or 5 years, which of course is the coal sector. Stocks of coal prices didn't collapse overnight, but they retreated relative to the global index incrementally almost every day for a long period of time, particularly as a result of the rise of the shale gas sector and struggling global economies as well as local environmental regulations. So, in the context of climate change, are we facing one of the most, if not the most, significant uncompensated systemic risks that investors have ever seen? And if we start to use that sort of language, systemic risks that can't be diversified away across a large portfolio and are not providing the upside for being taken on compensation, then we can start to enter the rooms in which asset allocators are sitting making their investment decisions. Some of these things were supposed to fly in, but they're not seeming to in this format. But anyway, the top of this slide really contrasts in the top between climate change as an issue about weather and climate versus climate change in the bottom of the slide in the context of what society is doing in anticipation of a worsening climate. And I would argue that it's the bottom half which is the major issue for investors today in this crazy world that we live in of discounting, in which the value of our children and our grandchildren's lives is incrementally less, or is dramatically less as you go through the generations, which doesn't make any sense in the context of an existential crisis. We all know that. But let's think about investment risk analysis in the context of what society could do in the anticipation of major catastrophic climate change. Impax has developed a model for how to think about this as an asset owner. I'll just run you very quickly through this. There's a white paper on our website if you want to learn more. But essentially, if you look at risk in the context of how much money you could lose in profit terms, it's worth thinking about your industry in the perspective, or from the perspective of how much it costs to get your stuff out of the ground if you're a fossil fuel owner compared to what you can sell it for. So if you think about governments putting some sort of price on carbon, a tax, and the effect that that has, which is to do a couple of things which are nicely summarized in this slide. Industry volumes will go down if governments intervene, wholesale prices will go down, retail prices will go up, and there'll be winners and losers. Now, if you can get into the asset owner's conversation with that sort of framework and some numbers and a model that backs it up, you can start to have a pretty rich discussion about what to do with your investment portfolio that doesn't necessarily need to bring in ethics, morals, or even investment beliefs. It can simply be based in hard-nosed maths with some science informing your scenarios. There's been a lot of talk about carbon footprinting. Now's not the time to go into it in detail, but I would put in a health warning with carbon footprinting. This is a well-known, very well-run Irish company called Kingspan that makes insulation material that goes into buildings. Using a simple carbon footprinting methodology, it is a net emitter of carbon because it's a manufacturing business. But if you take into account the carbon avoided in the use of its product, then it becomes massively negative in terms of carbon footprinting. So watch out if you're using carbon footprinting for assessing risk. I was asked to comment on the investment opportunities. If you're going to divest, well, I think energy efficiency has to be the standout no-brainer. If you remember, I said that carbon pricing, carbon taxation will lead to a rising retail price. That means that energy efficiency payback periods rise, and businesses that are manufacturing construction materials like Kingspan, smart grid components, smart lighting, LED type systems are seeing huge opportunity both for top-line growth and for margin expansion if they've got good technology portfolios. Renewable energy, in contrast, taps into wholesale power pricing, distributed or undistributed. But if you look at the absolute investment opportunity for renewables, the top of the line, green, yellow, blue, etc., shows the expansion of renewables in the European Union over the next 15 years. Below the line is the retreat, particularly of coal, which hasn't come out in the index. But the grey is coal going backwards, as is nuclear in most years up to 2026. So where do you want to place your money? Well, you should be placing it, of course, in the growth industries. So if you're going to divest, yes, it does make sense. It's a no-brainer to invest in energy efficiency, selectively to invest in renewables as well. So in conclusion, what Impax is doing with various pension fund clients we have is building the debate around using some pretty straightforward maths and science to take account of investment risk as it's emerging in the context of government action or societal response through demand reduction, in the context of climate change, rather than scenarios about damage from weather or climatic belt shifts, which are probably so far out in the future that in the crazy world of discounting, sadly, they don't count very much in today's net present values. The final component is a portfolio optimizer, which groups like Amundi have been using, but if you do this properly, you can actually minimize tracking error. You can protect yourself against certain Turkey-type scenarios, and all being well with the right investment decisions, you can make some positive alpha as well. Thank you.
Would you? So I think that Véronique Menou, the Vice President of ESG Research and MSCI, or it is part of it, I'm not quite sure about that, it's part of it, might have some more Turkeys for us.
Thank you. Thank you very much for inviting us. MSCI is very happy to be here. We've been doing work around carbon and climate change more broadly for more than 20 years now, so really happy to contribute to this debate. Just wanted to say a couple of words about MSCI, as an introduction for those of you who do not know MSCI. So MSCI is an international company that provides tools to institutional investors to better manage their portfolio. So our product line includes equity indices, real estate benchmark, analytical tools, as well as ESG research. We are obviously very well known for our equity indexes. We calculate every day more than 160,000 indexes daily. But we are also the largest ESG research firm. With more than 200 people dedicated to ESG research. And we have 40 years of experience in ESG research, as well as serve more than 800 institutional investors worldwide. So those investors that are willing to integrate ESG signals into their investment decision-making process. Okay, just to now go through this presentation and share with you some of our research findings, I just wanted to start with a couple of facts. I'm sure you're well aware of all those announcements by institutional investors willing to divest from coal and fossil fuel. Obviously, we've noticed that as well within MSCI ESG research and MSCI more broadly. We've clearly seen a steady rise of announcements and demand from clients willing to reduce their exposure to fossil fuel. So I've listed some of those statement here on the slide with Stanford, but also Bank of America, Church of England, etc., announcing their plans to divest from coal. But what are actually the implications of divesting from coal or divesting from fossil fuel? And in particular, how can we go from a broad diversified equity benchmark to a benchmark that will reduce exposure to fossil fuel? And I think this chart, the chart that you can see in front of you on this slide, is actually very illustrative because it shows that fossil fuel and risk associated with carbon reserve are actually very concentrated. First of all, it is very concentrated by sector. Because if we talk globally, if we look at our flagship universe of ACWI, which is the All-Country World Index, that would include 2,400 companies in both emerging market and developed market. 80% of the potential emissions coming from fossil fuel reserve are actually concentrated in the energy sector. So it's very concentrated by sector, but it's also very well concentrated by company. If you see, what is highlighted in red on the graph is that with less than 3% of the ACWI benchmark actually represent more than 50% of the total emissions coming from fossil fuel reserve. So this is very helpful and very interesting to know, in particular when you want to construct an index that would reduce exposure to fossil fuel reserve. And so what we've done at MSCI is actually, develop a wide range of environmental indices that go from the thematic ones, and those thematic indices actually aims at selecting or identifying those companies that provide solutions to climate change and environmental challenges more broadly. So for example, in those thematic environmental indices, we are selecting pure play companies, so companies that generate more than 50% of their revenue in clean technologies. On the other side, we have the low carbon family. You've heard about the FRR earlier, before the panel, with Olivier Rousseau mentioning the collaboration that MSCI and Amundi and the FRR and AP4 have done last year to develop the family of low carbon indices. And what those low carbon indices aim to do is actually reduce the exposure to the two dimensions of the risk. The long-term dimension of the risk by reducing exposure to carbon risk, to carbon stranded assets, but also reducing the short-term dimension of the risk using optimization techniques to reduce the tracking error compared to the index. But what I wanted to share with you is more some of the findings of the fossil fuel exclusion family that we've launched last fall. So we have two types of fossil fuel exclusion indices. We have the MSCI Global X Fossil Fuel Index that will just exclude companies that own fossil fuel reserve. And we have a less restrictive version that just focuses on coal, which is, as you know, the most carbon-intensive fuel type. And so what this X-Coal index is about, it's actually an index that is designed to represent the performance of a broad global equity market while excluding companies that own thermal coal reserve. And what you can see in the table at the bottom of the slide is that actually in the ACWI universe, again 2,400 companies, including emerging market and developed market, there are actually 26 companies that own thermal coal reserve. And so that represents less than 2% of the ACWI benchmark. Now I also wanted to share some of the performance metric. Sorry if it's not easy to read for you. So on the table on the left-hand side, you can see some of the performance indicators. So what you can see based on the simulation that we run over the past 5 years is that the ACWI X-Coal index actually slightly outperformed its parent, so the ACWI index. But also in terms of risk, it's very well aligned with its parent. With a very minimum tracking error of 30 basis points. So basically the screen that we are applying to the ACWI index, which will exclude 26 companies, doesn't really have a huge impact in terms of the tracking error. So it's very well suited for passive investment. On the right-hand side, you have you can see a table that also shows the performance year to date as well as 1 year back and 3 years back. So similarly, you can see that the ACWI X-Coal index slightly outperformed the benchmark. But what is also very interesting to look at with regards to this X-Coal index is the carbon footprint. So what we've calculated is the carbon footprint of the index, looking at the carbon emissions, so scope 1 and scope 2 over sales. But what I'd like to highlight here is more the potential emissions that are coming from fossil fuel, from coal reserve. And what we see here is that by just excluding, again, less than 2% of the weight of the index, so 26 companies, we're able to reduce the potential emissions coming from reserve by 50%. On this slide, you can see some of the bottom active weights. So the largest exclusion by market cap. So you won't be surprised to see some of the big companies that own coal reserve, like BHP Billiton, Rio Tinto, Sasol, Anglo American. So those are some big names that are excluded from the coal index by market cap. But just to wrap up here, what I wanted to say is that definitely we've seen some interest from institutional investors around reducing exposure to coal. That applying a coal screen doesn't really have a huge impact in terms of the companies and the market capitalization that is excluded from traditional benchmark. So we've seen some interest from institutional investors in particular willing to either create coal-free portfolio, but also interested in developing passive investment products. Thank you.
Thank you. Could you just hand the microphone over to... Thank you. So Nick Robbins already was mentioned in the video speech we heard from Achim Steiner. He's the co-director of the UNEP inquiry into the design of a sustainable financial system. So the systemic risks Ian Sims was talking about probably were part of your work. You have the word.
Thank you very much, Dagmar. And thank you to the organizers for inviting us to speak. I think UNEP's actually got three opportunities. We had Achim Steiner, we heard about the decarbonization of FFR, and I'll be talking about the sustainable financial system work. What I really want to give to you is a sense of a very new shift that is going in terms of how should the rules that govern the financial system, how should they be aligned to long-term sustainable development? What is the role of central banks? What is the role of financial regulators? And hopefully complementing the work that we've already heard and the great work that we've heard today. So three messages from the work of the inquiry. We've been working for about 2 years now around the world in 15 different countries, looking at actually what's happening in terms of the regulatory system. And these are the three main findings. That actually, if we're thinking about moving to a sustainable economy, that actually we need to act within the financial system as well as the real economy. As well as pricing carbon, we also need to think about the rules of the game in terms of disclosure, in terms of investor behavior, and so on. Secondly, that actually this action is already happening. We've identified about 120 individual measures around the world which are actually in place right now, which are trying to direct capital towards a more sustainable end. Interestingly, much of this leadership is coming from developing and emerging economies. And our final conclusion is that we are now at the point when we can think about more systematic action at the national level, particularly bringing together what we call national compacts, where you actually look at groups of stakeholders coming together for shared ends, but also in terms of international cooperation. And we're in a very special time for international cooperation. The Financial Stability Board, set up after the crisis to look at stability in the wake of that huge shock, is now looking actively at climate risk. We're at a very special moment. This is, in a sense, the challenge. I don't expect you to look at all this, but this is, in a sense, the system. We have providers of funds on the left-hand side. We have the whole intermediation system in the middle, the financing, the banks, insurance, and so on. And then we have the users of funds, people, either households buying houses or enterprises and so on. And we need to think about the issue, particularly the challenge of climate change, as a reallocation exercise. The IPCC tells us that each year, in terms of real capital, we need to invest an extra $1 trillion in clean energy, particularly energy efficiency, and also we need to reduce capital expenditure of 530 billion less a year. This is real capital. It's not necessarily stock market investment, so it's a capital reallocation exercise. We have that the capital is there. The overall financial system is worth some $300 trillion, and our annual global investment is about $16 trillion a year. So the capital is available. What would success look like? I would really just like to think about maybe sort of three of these sort of measures or success factors, the bottom three on the bottom right, that actually a financial system would be sustainable if it is deploying the capital to meet sustainable development needs, that extra $1 trillion for low-carbon transition. It would be reducing the capital for the high-carbon, high-resource intensive, that $500 billion a year in capex that we need to reduce. And critically, it would would be providing critical financial services, access to finance for the 50% of the world's population who still do not have basic bank accounts. So we need to think about that inclusion agenda at the same time. What have we been doing? We've been given a mandate to actually look at policy options, what it is that practical policymakers can be doing in different parts of the world to actually align the financial system with sustainable development. We've been going to ground, we've been going to different countries, about 15 different countries, and I'll give you some examples. We've been working with a series of international leaders around the world. And finally, we've been pulling together options. And this presentation is very much a work in progress. Our final report will be presented in October this year. So these are our network of partners. We're delighted to work with many organizations here in France, with the 2 Degrees Initiative, CDC, Climat, and also France Stratégie, but also with a number of central banks around the world, the People's Bank of China, the Central Bank in Bangladesh, and also the Bank of England. A number of new players in the sustainable development agenda, in the climate change agenda, are now thinking about what is their role? What is their role to ensure we have an orderly transition to a more sustainable economy? So what are we finding? As I said, we're finding that we're actually going through what could be called a quiet revolution. We've identified at least 120 separate measures which are being undertaken around the world to better align the financial system with sustainable development. And they're being done for very, very different reasons. In China, it's largely air pollution. Globally, 7 million people die a year because of air pollution. China is facing very, very serious air pollution, water pollution, soil pollution, and there's now a commitment within that country to develop an eco-civilization. What are some of the approaches we're seeing here in France? We saw the great leadership exemplified on the 22nd of May with the agreement of Article 48 of the Energy Transition Law, new requirements for investors to actually make public how they're going to manage this transition to a low-carbon economy. We have a prudential review in my country, in the UK, looking at the insurance sector. How is the insurance sector managing the physical risk of climate change? How is it managing the stranded assets risks? In Indonesia, interestingly, you have now a 10-year roadmap for sustainable finance, very much born out of the financial crisis, a recognition that a more sustainable financial system was needed. So what are the sort of policy packages that can be put together? On the left-hand side, we're seeing essentially 5 different sets of tools that financial policymakers and regulators can use. In the middle column, it's actually where can these be deployed? And then on the right-hand side is actually what do we need to do at the system level as a whole? But if we look at the tools, there are a whole series of tools that are already being used. Improved disclosure, defining responsibilities such as fiduciary duty of investors, product criteria, for example, for green bonds. We also have the issue of how do we better harness public resources, particularly at a time when public funds are so constrained. How do we better use fiscal incentives? How do we deploy public institutions, development banks, and also the balance sheets of central banks? And it's great to see Baptiste Parassin-Faber here, who's been putting together some very interesting ideas about, for example, how the European Central Bank could be using its quantitative easing program to drive a low-carbon transition. So a new role for central banks. There's also a role in terms of actually more policy direction. Clearly, it's a policy tool that's used more in developing countries. But for example, in Bangladesh, from next year, all banks will have to allocate 5% of their loan portfolios to green finance, to energy efficiency, to renewables. And if they do that, they can get access to cheaper refinancing from the central bank. And finally, cultural transformation. We realized in the crisis there was a failure of culture that led to some of the huge volatility and shocks we saw. And actually, we need to think through the cultural aspects of this. Just touching on a couple of the policy packages, and I think this is where this agenda is so relevant for the divestment and decarbonization agenda, is what is it that policymakers can really do to actually drive this process. So if you take the bonds area, as Pascal has mentioned, making sure that credit ratings are actually including climate risks in terms of the way that they're assessing creditworthiness. In terms of equities, we have some progress in terms of disclosure, but only 30% of companies on the world stock markets actually disclose their greenhouse gas emissions. Got a long way to go on that. And then in terms of investment, as I mentioned earlier, France has shown really a leadership position in terms of disclosure by investors. So I think there's a lot that we can build on. My last slide is really thinking about next steps. As I said, we'll be publishing in October. This is a very, very alive, vibrant agenda, and I think there's a lot to move forward on. In terms of the left-hand side, what we need to see at the system level around the globe, we have many, many sets of principles and standards for the financial system. We have nothing actually setting out how we're going to drive sustainability. So a set of principles for a sustainable financial system. We actually need better ways of bringing the future into account, into today's decision-making, what Mark Carney calls the tragedy horizon. So we need new sustainability stress tests, which can actually both stress the corporations that are holding fossil fuels, and therefore investors are in a better place to understand what could be some of these risks. We need to better use the fiscal resources in the financial system. And we also need a performance framework so we can understand whether the financial system is actually allocating capital effectively to the transition. And then on the right-hand side, if I might just sort of pick out a couple, a code on investor duties. We have a lot of progress now in terms of alignment around fiduciary duty, but an international code on that could be helpful. And secondly, a real push, I think, on sustainability disclosure, a lot of momentum, a lot of very, very good initiatives. Perhaps this is now the time for the International Securities Organization, IOSCO, to bring together the securities regulators and drive forward. We've heard a lot, I think, today about the energy transition, the Energiewende. I think our conclusion that we also need a finance transition, a Finanzwende, and I think this is a very exciting agenda to take forward. Thank you very much.
So thank you. We have less than 10 minutes in that session, and so I ask you for your questions. 3 or 4 should be possible. I see here in that line and in that line, so maybe we start here in the front.
Hi, thank you. I just wanted to ask a question about scale. In the first presentation, I think there was a number of 21 trillion additional that might be invested, but I wondered if you might give us a total of the amount of trillions that are currently invested that would be of no value, and explain how the financial value of reserves relates to the actual volume in the ground and how that changes as the financial value changes. And if we take that money away, is it simply possible to reinvest all of that in other things? Or do we actually need to reduce the total scale of stocks invested so that we have a financial system that reduces in scale such that it's within the scale of our planetary boundaries? So, if we need a 3-fold reduction in our resource use globally, do we need a 3-fold reduction in the scale of our financial system?
So first, please tell us who you are. And second, I take 2 more questions and then let answer who feels able to.
Yep, Jonathan Essex, Green Party UK.
Okay, and just behind him.
Yeah, my name's Rufo Quintavalli. I'm a private investor and a Divest Invest signatory. I had a question about indexes. I was just looking up the MSCI Global Low Carbon Leaders Europe Index because it was mentioned. Of the top 10 holdings in the index, none of them are in renewable energy or in energy efficiency. And the 4th line in the index is Royal Dutch Shell, who are currently drilling in the Arctic. This is not to bash MSCI. It's just to say that if we're investing on indexes or via indexes, and those indexes are benchmarked onto the global indexes, we're never going to significantly deviate from the current system.
So, and then probably the last one, at least in that round, would be the young man here in the middle. And then I let somebody try to answer your questions, and then we see where we are.
Hi, I'm Pekka Piirainen. I'm a UK divestment campaigner. Building on the last question, there's been a lot of talk around carbon footprinting and sort of related risk analysis. And relating to the previous problem that was raised about, for example, Shell being on those low carbon indexes, do you think that incorporating scope 3 emissions, so the indirect emissions, and not only scope 1 and 2 emissions, the direct emissions, into those low carbon indexes could be a solution to that problem?
So I think Mark should start with the trillions.
Yeah, no, these are some big numbers. If you can't find on the web, email me. I think it may have been covered in The Guardian, actually. Citigroup produced a paper 2 weeks ago saying that the revenues forgone from not developing fossil fuels is around 100 trillion. It's not 100 billion, it's 100 trillion. So there's a lot at stake here. And Carbon Tracker's position on this is that we have to have an orderly transition. We have to make sure we're not investing in fossil fuel projects that could get stranded, that have no place in a low-carbon future, and that we should be diversifying into low-carbon opportunities very, very quickly. They then went on to estimate, Citigroup then went on to estimate, actually, is it better to decarbonize, better for the economy, or is it better to continue business as usual? Thankfully, the numbers say it's better to decarbonize. So there's a lot at stake. And here's some of the questions we don't know the answer to. In the UK, for example, the government gets around 26 billion sterling a year from fuel excise duties. Now, on top of that, you add taxes on the oil industry, and you've got taxes on national insurance contributions on workers working for the oil industry, plus licenses and so on. To decarbonize, there's going to be a hole in the balance sheet of national economies on the state who are raising taxes from this industry. And we have to think very hard at what are we going to replace that with, and it's work that needs to be done urgently to make this readjustment in our economies. One of the biggest resistance to change that we're seeing is treasury departments across the world who look at revenues from the fossil fuel sector and ask where are we going to replace it. And we've not been very good as a community in thinking through some logical answers to some of those important questions. I'll leave the other two questions to others, but I do have my thoughts on those as well.
Yeah, Ian?
Maybe just to add to that, the global market for energy efficiency products at the moment is somewhere around $350 to $400 billion a year. There's an estimate of about the same again of untapped potential, so you could double that if information was flowing correctly. The aggregate market cap of the energy efficiency companies that appear in the FTSE Energy Efficiency Index is about $900 billion. So I think those numbers do demonstrate that we're a long way off being able to absorb in energy efficiency the monies that are being currently invested in prospecting for new fossil fuels, which is why the 99.99% of investors couldn't all shift their money out today. But I think that does point to some fantastic opportunities for early movers who are divesting and reinvesting smartly at the moment.
So I just give the rest of the panel a chance to react to, especially Véronique.
Yeah, sure. So I can comment on the low carbon leaders, which is not necessarily the one that I presented today, but I think the methodology was outlined by Olivier Rousseau of the FRR later on, earlier, before the panel discussion. So what this index aims to do is not exclude all the fossil fuel companies. So the fact that Royal Dutch Shell is in the index and also appears as a top line is first of all because it is a large market cap. It has a large market cap, and it's not among the most carbon intensive company in its sector. So basically the low carbon indices, what they aim to do is reduce the carbon footprint of the index compared to the benchmark. But there is this best in class approach, meaning that we are excluding companies that are the largest carbon emitter in their sector. And Royal Dutch Shell, even though, on an absolute basis, I agree with you that it is a large contributor to climate change, from a relative basis compared to its sector peers, it is not among the top. So that is why it's in the index. Then the second question about energy efficiency. What I've outlined is our range of indices. We have different indices. We also have one that will select company based on the fact that they are energy efficient. It's not factored in the low carbon leaders methodology because that's not what this index aims to do. This index aims at reducing the carbon footprint rather than and looking at carbon emissions, Scope 1 and Scope 2 over sales. Right? Rather than the energy efficiency, we also have tools or indices that would select those companies that are energy efficient, and that also provides tool for or technology to reduce or to improve energy efficiency. And then the other question on Scope 3, for now Scope 3 is not taken into account in the methodology. There have been lots of discussion around Scope 3. I think Nick earlier mentioned that in terms of disclosure by companies, even Scope 1 and Scope 2, it's about 50% of the companies that do report. Scope 3, it's a very low reporting rate. So at this stage, the Scope 3 data is very poorly defined and poorly reported by company. That said, there are lots of discussion around it. It's definitely, you know, an issue that we are monitoring, and we need to first get better quality data in order to, you know, use it in an index methodology. But this is something that, you know, we track, and we also have data on Scope 3 within MSCI ESG research. We use that in our analysis for rating companies on climate risk. But for this particular index, we felt that the data was not of good quality in order to be used in the methodology. That doesn't prevent us from, you know, thinking in the longer term and including it if we think it makes sense and if we have better quality data.
Pascal, you wanted to add something?
Maybe on this issue, and I may switch to French for the second part of my speech. Peut-être là
So in this case, you know, we are lifting the hood of a divestment. So what does divestment mean? Divestment means, does it only mean I'm removing the peers, but I'm remaining on a trajectory that is not compatible with this 2-degree target? Whereas when you're an activist, when you campaign in favor of divestment, then you need to find indexes that are in line with this 2-degree target. But unfortunately, we don't have such indices so far, because our economy is not compatible with this 2-degree target. And even with the indices, we are still stuck in the current economy as it is right now. And I'm really talking about listed companies here. So you need to bear in mind, because even investment people, they tend to forget sometimes that listed companies are more carbon intensive than companies in the real economy. Because, service companies are not listed, education companies, childminders, they are not listed companies. So those listed companies that are used for indexes, that are used for those investments, are obviously companies that are much more carbon intensive than other companies and the rest of the economy. And there is this tracking error aspect, and if you are all aware of this tracking error thing, but it's about defining how an index can reflect an economy or whether it can deviate from the actual economy. And if you don't want any gap, then obviously you remain in an economy that is not in line with this 2-degree target. It's not compatible. So we're not here to bash. We don't want to do any bashing.
But backstage, what it means. BMW if everybody on this planet Earth owns a BMW car, I mean, forget the 2 degrees, okay? What is the most energy efficient car maker? BMW. So, what do you like? What do you look at? So, c'est forcément plus compliqué que...
So, it's much more complex than it seems. So, we need to avoid 2 pitfalls. You need to avoid finding the wrong solutions. That means that you won't really change much. And you need to make sure that that you're not oversimplifying things. It's extremely complex, especially when you have specific mandates, when you have to manage a pension fund. So the Dutch example is extremely interesting. And I think that judges are going to have a look into such cases, into similar cases. And it's all true for asset managers. In the Anglo-Saxon world, you have what we call fiduciary duty. You have pensioners who trust you because you are managing their savings and you need to handle the risks. And right until now, the climate risk, the risk that economic models would change, has been ignored by asset managers. And there are some lawyers in the US, and I'm sure it will take some time, maybe 2, 3, or 4 years. And I mean, that legal aspects always take a long time to be dealt with. But I'm sure that we will have US lawyers who will have won cases against asset managers who will have ignored the climate risk. And when you're a US citizen, if you're in the city, if you're in Singapore, this is the real risk, isn't it? Because once you start having, thousands of pensioners, people saving money who sue you, then this is when you start thinking differently. And this is something that a 350 could do, I guess.
So Nick has the privilege to wrap it up completely.
I will stay in English, if I may. Thank you. And I just wanted to respond to this question about, in a sense, excess finance, because I think maybe just sort of, for me, summarizes the question about what we expect out of the financial system. And if we think about three things we expect out of it, we want it to be effective in terms of allocating capital to where it's needed for long-term sustainable development. So actually more for low carbon, less to high carbon. Secondly, we want it to be resilient. Clearly a performance factor which the financial system has woefully failed at recently, but resilient in terms of its ability to withstand increasing shocks in terms of natural disasters, but also transitional issues. And thirdly, we want it to be efficient. And here is where I'd like to cite some work from the International Monetary Fund, which has shown a very, very interesting relationship between the size of the financial system and the overall economy. That actually, as the financial system grows, you have more people having bank accounts, you have better intermediation, so there's a positive relationship with growth and development. This can actually reverse, however, and that's what you see in a number of industrialized countries. There is a bell-shaped relationship, and you can have excess finance. So actually, whereas in most sectors, increasing complexity leads to increasing stability and reduced cost. So think of an Airbus, very, very complex, but actually much, much safer and actually lower cost than previous generations of airplanes. The financial system actually has not been getting more efficient as we've been adding more technology. It's actually been getting more volatile, and actually we continue to have a huge rent extraction from the real economy. So I think these three factors we need to think about. Firstly, that it's effective in serving the green economy. Secondly, that it's resilient. But thirdly, also, it has to be efficient. Thank you.
Thank you very much. There's sadly not more time for more discussion, at least today, but I think that second coin is exactly what will be debated much longer. So I give the word back to Reinhard, I think.